This is once in a lifetime opportunity, the best opportunity that I've ever seen, period. During the financial crisis, you could buy a garment center building for $300 a foot, but inflation adjusted, $300 a foot is now around $190 a foot. And if you bought a building back then for $250 a foot, it's equivalent to around $160 a foot. So now that we're saying like, oh, we're back at $300 a foot, the real value of it is actually $160 to $190 a foot. I'm a New York or nowhere type of guy. And I used a photo of the South Bronx in the early 80s. And then I posted a picture of the South Bronx today. And I said, you guys have no clue what you're talking about. Turn off the news. You guys have zero clue.
So, Chris Okada, thanks for coming on.
Absolutely.
Welcome to the Broker Brunch.
Thank you. I'm excited.
I mean, you just said you had that sign in your office. I remember during COVID, you were giving a big push. New York's the best city in the world. I know you're passionate about the cities.
Yeah.
So you're a lifelong New Yorker.
Yeah. Born and raised here in New York. Grew up in Forest Hills, Queens. And really, during the pandemic, when literally everything was shut down, I did spend time. I went down to Florida in Palm Beach County in Delray Beach. And I spent about a month down there in the month of June of 2020. Quarantine began sometime in March or April, and everyone was going down to Florida. So I went down to Florida. I actually set up shop. I am a guy, I need a daily routine. It's very, very hard for me to go from bedroom to living room and try to make a living that way. It just never really worked for me, even as a 20-something-year-old. And so I got a private office at a flex space in Delray Beach, and just started, Property Shark, making the calls, seeing how I can add value to people down in South Florida. The world was shut down. But in South Florida, it was kind of open. So it was definitely a lot less restrictions and a lot less sort of quarantine-ish, if you will. But then as the month was going on, I was just looking at basic economic data and information for South Florida versus New York City. And New York City has a $2 trillion GDP, and Florida is trying to break 500 billion. So and you felt it. I felt it. I feel like I was on vacation, even business lunches or business dinners in that short period of time, just felt like, oh, I'm down in Florida and it's fun. And so at the end of June, I said, there's not much here for me. And that's when July 4th headed back to New York City. And I just started and I thought we were done, to be honest. I really thought summer of 2020, I thought we were finito. I thought our company was finished. Really? It was fiscally and financially our worst year. Our just expenses continued, even with forbearance on leases and debt and all kinds of things. It was a really, really tough time. We don't have a lot of corporate debt. We have no corporate debt except for like a company credit card. So that was our saving grace, to be really honest, because it got so lean and it was not lean. It was totally in the red. Okay. And that's when Okada Company 2.0 really just happened. In 2020, it was my 18th year in New York City commercial real estate, and our company's, I think, 15th year. So 14th or 15th year. But, in summer of 2020, I really thought, wow, you can work for 20 years and then in 90 days, it could be all gone. And when I say all gone, I meant like it could potentially set you to negative, not zero. Zero is like wonderful. It could set you to negative, lots of money. And that's when it's sort of just all the ego was stripped, because in our industry, ego is a big component of personalities we come across. the wonderful thing in 2024 and 2023 and post-pandemic is there's no egos. If you have an ego, you're not a player. Or you're in other areas of commercial real estate. Gotta watch
Watch the camera.
All egos were stripped because for 18 years, almost, it felt like every decision I made was correct. But it was not that. It was just that I was hardworking and grew, experience and grew a client base. And it just was just the grind time. I did have the 08 and 09 experience, but that propelled us. So it seems like in the last two cycles, and I'm going to knock on wood, because every time there was an economic crisis, our company doubled in revenue, or it propelled my career to the next level. But 2024 and 2020, really March of 23, after SVB and after Signature Bank and after First Republic, from Q1 23 to now, it's been absolutely crazy as far as the general marketplace. And in the financial crisis, I got a book in the airport, and the name of the book is something along the lines of "Embrace Chaos." And it was just like a 120-page book. I'll send you a link,
Please.
And then maybe you can link it to your viewers. But essentially, it says, look in the chaos, look in the burnt down house, look in the mess, because that is exactly where the future will lie. And so embrace it. Don't be afraid of it. Don't look at it, as, oh my God, everything's terrible. Look for the lesson and then look for the puzzle pieces. So when I was in my 20s during the financial crisis, I read every bit of that book. And in 2020, I bought another copy of that book. I couldn't find it. I was like, oh no, where's the book?
We learned the lessons.
Yeah.
Yeah.
And it was essentially just embrace chaos and, figure it out. But look into it. Look into it. What has changed? What is chaotic? Okay. So right now in 2024, the capital markets are absolutely chaotic and frozen, especially because of the banks. Mostly in office, retail, hotel. I think multifamily is fine. But if you look into that frozen debt market, as far as the chaos or the problem, there's so much opportunity there. That's where the opportunity is right now. If you can solve for it, or if you can find liquidity and then create a debt fund or create a debt solution or a pref equity or mezz solution.
So identify the problem, then prescribe the solution to it, and you'll always have some sort of business plan. There's a lot to unpack there in what you said. So you were trucking along nicely, 18 years, you said.
Yeah.
So you were doing your thing at Okada Company. Yeah. You started in the the great financial crisis, yeah. Right? So you had a good run, and everything was probably going well, yeah. And like us as well, right? So yeah. On the brokerage side, I just felt like I was finding my stride. Yeah. Just felt like things were finally taking off, yeah. And then bang, this random pandemic started. And it was a reset for everybody. And like you, I remember going down to, my in-laws' basement. I didn't get to go to Florida. I was up in Rockland County. But it was a time where you really felt like although it was scary at the time, sure. It was a huge opportunity. Because you got to do the thing that you were putting off or that you just didn't have time for. Like you were saying even about comparing Florida to New York. That's a really interesting way of thinking about Miami, right? I think you said 500 billion. Yeah. And then when you 2.3 million in New York. So even just framing it that way, you knew you had to get back to New York.
Yeah. And the landlord started reaching out to us because a lot of the competitors were not in the office. And our company, myself and one associate, started coming in daily, even in April and May when we were not really supposed to. But I also own property, so property managers at the time were allowed to go, and certain building staff were certainly allowed to go, following protocol with safety and masks and all that stuff.
Can you explain your operation to us? Because I feel like for Okada and Company, I see, correct me if I'm wrong, it seems like an umbrella name, and then I see a brokerage, I see an operator, I see
investments. So let me take a step back. Really, our best claim to fame is our office leasing operations post-pandemic.
That's your bread and butter?
That is the bread and butter. That's what pays for everything, really. But with that comes the uncovering of opportunities, the servicing of clients. Those become potential partners, and it sort of blossoms into a more end-to-end solution, which is essentially investments, leasing, some sales, and some construction management. So really, we are an end-to-end solution. But for the most part, for the outside world, really, we are a brokerage and commercial leasing, especially with a highlight in office and retail. Our specialty is, let's say, the west side of Midtown, 57th Street down to 14th Street. That's really where most of our portfolio is. We know block by block, building by building. And so the west side of Midtown South. And, but yes, being a broker, let's say in the 70s, 80s, and 90s, all the power agents and leasing brokers, they bought buildings as well. Now it's sort of like, oh, are you a broker? Are you an owner? But most of the principals at Newmark were landlords that became property management, but then they brought on leasing teams that then became principals in properties. Same as, the ABSs of the world. And really the property management in the, let's say, before the 2000s was really the center of it. And as brokerage matured, if you will, especially in commercial real estate, the specialty became really, really important.
The business became a lot more sophisticated, didn't it? I feel like it wasn't so much as you can be a general practitioner anymore who manages leases, sells. You have to be
When I first started, a property manager did the construction management. Now, construction management is its own science. Project management is its own science, and property management is its own science, and asset management is its own science. It used to just be the property manager did everything, was the asset manager, was the CM, was,
one-stop shop.
It's the same in the brokerage business, right? Everything's become a lot more hyper-specialized.
Like even what you've done or what we've done, right? We talk about like focusing on neighborhoods, focusing on the Bronx, focusing on Upper Manhattan, block by block.
Yeah. And then you develop your niche even within that marketplace, what you become known for doing.
Yeah, I think the Bronx is what an incredible story in the past 10, 15 years.
Have you looked at many opportunities there?
I have not looked at any opportunities, to be quite frank. But I take the train to Westchester, and it's just it's a new city, especially in the South Bronx area on the water. It's insane. Yeah, what's happening over there.
Mitchell's leading the charge. How many deals this year, Mitch? Give us the numbers. He's got the numbers.
7 deals, another 3 in contract, over 100 million.
100 million in the Bronx. I would have thought like that's the entire Bronx.
Now, is this industrial land, multifamily?
No, that's just land. Well, that's a combination of residential development and one industrial piece of land.
Got it. Amazing. Good for you.
Thank you. So office, big question. I'm sure you get asked all the time.
Yeah.
What is the future of office?
I think the future is very bright in office. That's where I place my bet post-pandemic. When I say I placed my bet, we went all in on the landlord representation because they were completely underserved. So being a leasing broker for landlords in Midtown and Midtown South, and our numbers just started skyrocketing. Really, it's because we paid attention This year alone, we've had over 3,600 companies reach out to us looking for office space.
Wow.
Yeah, so really, really high volume. We've consummated around 121 office transactions. We're close to 1 million square feet post-pandemic of new office leases signed, not renewals,
Okay.
not including renewals. And I don't know. We've stabilized. It's really neighborhood by neighborhood as well, and every neighborhood's different. So Grand Central, I think, is on fire. I think that rents really hit rock bottom last summer, maybe.
I was walking down Park Avenue the other day and looked up at JP Morgan's new building. And looked down, and Jamie Dimon was right in front of me. I should have got a picture. I didn't. Yeah, but it's booming. It's booming along there. There's a lot of happening.
Oh yeah, 270 Park. They bought 250 Park. The big JP Morgan story, as a side note, is that they have 1.6 million feet sprinkled throughout other third-party buildings, and they all expire in 2026 to 2028. So there's going to be a nice little void on that Park Avenue stretch of 1.6 million feet, which is significant and not significant, but it's definitely going to give some landlords agita, and like, oh, what do we have to prepare? We have to, because if you have a, let's say, 600,000 square foot building and JP Morgan occupies half, that's a significant,
it's a big void to fill.
1.6 million is what of that market roughly? Like, are we talking?
Oh, that's a good question. I'm not even sure.
Will it make it that? Maybe it won't. Maybe it will. But it sounds like a big number anyway in that stretch.
Yeah, it's on Park between, let's say, 47th or 46th to, let's say, 56.
And you've the who's who of office landlords there, I assume, right?
The who's who's.
Right.
And so they're sprinkled throughout. And so, but JP Morgan they bought the, I thought that they did extremely well with the banking crisis, buying deposits, buying debt,
well-run bank. They just don't really make mistakes, right?
When you buy a bank for 5% of its market value, that's, but, that's where it's sort of like your name, your credibility. And then you're like, look at our balance sheet. We have trillions of dollars. You want how much? You want 5 billion? Okay, sure. That's like an average Tuesday.
It's a drop in it's a drop in the ocean. And then to go back to the 121 office leases signed since COVID.
No, 121 this year.
Yeah. So that's a huge number. Congratulations.
Wow, thank you.
Of the, say, pricing metrics aside, which I'm sure you know, but like demographic, like profile, who's leasing?
It's really interesting. I get that question from every landlord. Who's the target tenant? It's healthcare, entertainment, technology, finance, marketing. It's really spread pretty evenly.
That sounds diverse.
It's very, very diverse.
Nice to hear. Yeah.
Yes, because this town is mostly finance and tech. So a lot of our product, which is more the class B, class, C product, not every company can pay $180 a foot. Not every company is a big hedge fund. Here in this property, we've probably done 30 leases for small entrepreneurial companies. And so it's really a mixed bag of tenancy, but that's what makes this town great. There's 70,000 companies.
Yeah. Wow.
And I think 2024 will go down as one of the most highest number of new entities being created for New York. And so I think it's really, really important for the city to continue to foster that entrepreneurial spirit. And it'll start off in a 500 square foot office. So here's a really cool office story that starts, it may have been in this building or another building on 38th Street, but no, it was on 545 8th Avenue. We put a company in there. They were sort of like a tech remote medical company. And we put them in 1,000 square feet. And today they're a global company. The name is Teladoc.
Wow.
So Teladoc post-pandemic just flew through the roof. But they all started out in 1,000 square feet, and it was a tech company, and they had 10 employees or 15 employees. And, they were just grinding it out. So, that's the kind of story. And it's 1 out of every 50 or 1 out of 100 that take it from 500 square feet and go to publicly traded and cross $1 billion in valuation. But, thinking about that, there's 70,000 companies. There's a lot of companies that are making 5 million, 10 million, 50 million, 100 million, et cetera, that no one knows about or talks about. So we service a lot of volumes and different sort of companies like that. And yeah.
How do you compete with the new mark, the JLL and the CBRE?
I would like to say that and I want to say this extremely cautiously, is that we grew around 10x in agency and square footage. We're now around 4.5 million square feet. We used to do landlord representation in 2019 for around 500,000 square feet, and now we're at 4.5 million square feet. All of it was JLL, CBRE, Cushwake. I just think that their business models, when they want more global companies, they're global companies themselves.
Yeah.
So when you have 150,000 square footer or 100,000 square footer, that will maybe take away time for you to foster relationships and doing deals with Facebook or with Amazon. So I think that there was a huge void that was created in the marketplace for that. And because of our tenure in the neighborhood, now it's 22 years and our company is 18 years old. So now, because of that track record of just hustling, leasing, doing one lease at a time,
you had a thing during COVID that was a great tagline, and it was every deal counts.
Every deal counts. I still believe in that.
And you were doing, it might be, I forget the numbers, but say it was like 100 a foot and, 10,000 square feet. And it was like, you were keeping the lights on, keeping churning.
That was the moment everything changed, that exact moment. So the every deal counts story is summer 2020. I'm in the office. We're sitting there. It's quiet as a mouse. There's no business happening. My associate Hero, who's been with me for a long time, he comes in and says, I signed a lease. It's wonderful. And I'm like, great. How big was the space? He goes, 500 square feet. Wonderful.
Beautiful.
How much money did we make? $500.
Let's go.
Let's go. But it was two things. Number one, proof. Yeah. There's still people that are interested that don't want to work from their basement.
The city still has a pulse.
There is. It's a flat line. It's
there was proof of life a little bit.
There was that's kind of all we needed. And I looked at him and I said, every deal counts. And then I just started.
Isn't that amazing?
Every deal counts. Every deal counts.
Yeah.
So even though it was 500 and, a year prior, my biggest deal was $217 million sale, wow. 17,000 square foot retail lease, you had
rode the gamut. You've seen the top.
I was living life, traveling. I would travel 8 to 10 times a year. No, money in the bank, really not. And then here I am getting excited over $500, of which my agent gets $250, so I $250. And, our monthly run rate is, a lot more than that. But that was the turning point. That was just a little spark that I needed. And then there was another one. And then there was another one. And they weren't the big companies. The big companies were not figuring out. It was the small entrepreneurial guys that said, I can't work from home. I just need 3 desks, and it's 3 of us, and were only going to come in 2-3 times a week.
They were
Yeah.
tapped out. And it was also a big opportunity for guys who never would have been able to get space in Manhattan to actually come in
Yeah.
and get the space, because everything it was a fire sale on office space, and in some respects still is. And it seems like even from a building sales standpoint, which is what we focus on, these office buildings, I mean, we don't sell office buildings just because we're not generally in this midtown area. But when you're selling buildings, a multifamily building, say for 200 a foot or 250 a foot, guys are saying, listen, we can buy Garment District, Midtown office buildings right now. We don't know what we do with them, but we can buy them on a price per pound. It looks pretty attractive. And it's hard to argue with that at some point, the fundamentals of real estate kick in. And when you're getting bricks like this in a location like this at that kind of a discount from where they were, it's really just a matter of someone creative figuring it out, how to get the bank out of the deal, right? How to get that all wrapped up, and then how to execute a business plan under the rules that we have.
Yep, absolutely right. So let's say in the garment center, the $250 a foot number, it is definitely, there have been trades of that amount, but not many. So there's this general fallacy that someone says, okay, I want to buy a building for $250 a foot. It's not possible. It's not that it's not possible, but your chances are still very, very slim because the properties, how are you going to finance them?
Yeah.
What you're taking out a bank, but what bank are you putting in unless you're going to buy it all cash, which is fine.
How are you going to carry it?
How are you going to carry it? What's your business plan? So there's definitely that, I can just buy for $250 a foot. Okay, then do it. It's extremely challenging. It's extremely hard.
What do you do when you buy it?
I mean, you're going to have to figure out, more likely than not, you're going to have to find some kind of income strategy. And that means if you're going to develop it into a different asset class, if you can, that's $300 to $400 a foot. So now you're bragging about $250. It's really like $650.
Yeah.
And then, so how are you going to make a 7% capitalization rate?
Have you looked at any of these residential conversions, like personally?
I have. It's challenging. It's a lot more, a lot more to it than people think. I got so many calls. Hey, we're interested in residential conversions because it's like the hot topic.
Yeah.
How many of them happened?
Yeah.
And you know who's doing it?
Silverstein, right?
Yeah, I mean, the usual suspects.
Right.
Silverstein, Brodsky, GFP. It's the real estate, like professional developers, Metroloft. It's not
the key about those guys is they have the staying power to carry it.
They have the staying power.
They're not
they understand that this is a cycle. They made all their money in the cycle, and they're here to diversify. So I definitely think though, even though I say, go ahead, try to buy it, I think for the most part, this is once in a lifetime opportunity. This is the best opportunity that I've ever seen, period.
Yeah.
During the financial crisis, which was pretty bad, you could buy a garment center building for $300 a foot, but inflation adjusted, $300 a foot is now around $190 a foot. And if you bought a building back then for $250 a foot, it's equivalent to around $160 a foot.
Okay.
So now that we're saying like, oh, we're back at, $300 a foot, the real value of it is actually $160 to $190 a foot.
Okay.
When you compare it to the market
08, 09.
from say 15 years ago.
Yeah.
Right.
That's an interesting perspective, actually. That helps put things,
Oh yeah. Inflation adjusted, we're at $150 to $200 a foot. We're actually significantly worse than the financial crisis.
You didn't hear that said much, but it's interesting to hear that coming out your mouth from an expert in this market.
Oh yeah. And I sold a building on the corner of 35th and 6th, 960 Avenue of the Americas. Sold that for $400. That's probably today around $250, $275. But on the avenue isn't suffering as much.
Yeah. Mid-blocks.
It's definitely the mid blocks. There is price compression. There are stories. There are people letting go of things. There is Columbia Property Trust just sold 799 Broadway, and they have multiple other properties that they're trying to figure out, or their lenders are trying to figure out, better said. And but that's why I think that this is such an incredible time, because yes, the last time we were here was 15 years ago, and in a few months it'll have been 16 years ago. The next time I think we may see a cycle like this will be 10 years from now to 15 years from now. So this is a once in a 30-year stretch. That's a long time in a person's career. So if a person's career is 45 years, probably you'll see this maybe one more time. But no one really knows. I mean, 10, 15 years went by, 16, 15 years went by very, very quickly.
You make a compelling case when you put it like that.
Yeah. I really believe it. That's why I'm really happy to have had this sort of growth. You guys striking out and making a niche. I think that growing with the upper Manhattan and the Bronx, I think that's a huge growth area. Someone recently said there's no money in Manhattan, which I thought was complete. I was
That's
like,
a ridiculous comment.
Yeah, this is strange.
It's like an oxymoron.
All the money's in Bronx and Brooklyn. And I was like, first of all, there's Queens. Queens is doing really interesting things, but
Yeah.
But
everyone has their own preferences, right? Based on their own success. Like if you did a deal in the Bronx, you lost money. You're not likely to do a deal up there again. It depends on the circle.
And you have different challenges that you don't have in other markets. Like even though the cash flow on a setup that we're showing could be a 9 cap or a 10 cap, but maybe collections are 40% down. So it's how do you really compare apples with apples? And I think going back to like your business in like core Manhattan, that stretch from the 50s down to the I think you said 14th Street.
Yeah.
Sure. So like that's a proven concept. It's pretty much blue chip real estate.
Yeah.
You don't really have to reinvent the wheel there. It's just a matter.
Actually, though, you did ask about how we compete against. Let's name the company.
Right. Say the top 5 institutional.
Yeah. It's really through our marketing. I think our marketing is pretty good. It's through social media. It's through getting really creative with our owners without asking them to spend $100 a foot. It's really visibility, increasing the visibility. There's a huge branding aspect to these people's properties, to our clients' properties. When you walk into a building, 123 West 14th Street, just a random, no one knows it. If you ask them, do you know 123 West 14th Street? No one on the street would have any clue. But you ask them, do you know what the Twin Towers were? Do you know what World Trade Center is? Do you know what the Empire State Building is? They all have some kind of clue or a story, or, oh, it was in this movie, or, oh, I saw that during 9/11, this happened, right? So our job is to bridge that gap and speak the brand of that particular property. And a lot of times the property doesn't have a brand. So our job is to help create the story, create the brand. What's the history of the building? The building was built in 1922. The original developers were this, and then there's a story.
You're the Ryan Serhan of commercial leasing on the West Side.
Well, I think so. It would be, an honor to compare me to him. But
you've hit on something important though that I think that you've captured really well on LinkedIn and across social media. Something that I think is really important is storytelling.
Sure.
When you're selling anything, if you can sell through storytelling, people can relate to it much easier. It becomes much more tangible. Yeah. So to your point about labeling a building or naming a building, it just makes it real, and it takes it from being an abstract number to being something that's a real living thing.
Yeah. Talk about the original architects. This architect was very, very famous in the 1890s. During that time, there was horse and carriages.
Yeah.
And this, was a furniture manufacturing, building. And just telling that story. And the same thing goes for the Bronx. I think that you guys could really paint an incredible picture for your marketing brochure if you wanted to. And then you would have a marketing campaign of the Bronx is rising, to go against the Bronx is burning,
Yeah.
right? Or something along those lines to talk about the history of the Bronx. Have you, someone, I did a LinkedIn post on this where people hated New York and they think it's disgusting. And I'm a New York or nowhere type of guy, right? So there's always like the few characters like, oh, you get mugged. I'm like, all right, first of all, I grew up in Queens in the 1980s and the 1990s. Like, okay, goodbye, right? First of all, like in the 1980s, it was way worse. Murder was way, murder, rape, theft, robberies. Those are the main NYPD stats that they always kept track of. It's like a downward slope. And then I used a photo of the South Bronx in the early 80s. And then I posted a picture of the South Bronx today. And I said, you guys have no clue what you're talking about. Turn off the news. You guys have zero clue. So I think for you, how cool would it be to go and discuss the history of the Bronx through the birthplace of hip hop?
Yeah.
Photos of just like rubble, like buildings that were created and demolished, lots that had buildings on them that were demolished.
Yankee Stadium through the decades.
Yankee Stadium.
That place where the Joker was filmed. What's it called?
The steps, the stairwell.
Yeah.
Come on, Mitch, you can do this.
But then to create a little lookbook on that.
Oh, yeah, that's cool. That's cool. That's a good idea. I like that.
Right? And then to say, be a part of this fastest growing, and then throwing statistics with, CAGR or growth.
You're 100% right. Every submarket, every asset type has the ability to become a story.
And you tell that story and then you break it down to this industrial lot or this, residential development. I got to careful with my hand. But, then to be able to do that and then really just tell that story over and over and over. And it's funny you bring up every deal counts. Because this year, this slogan was generational opportunities. And I've just been screaming that.
You're gonna say the same thing over and over and over again.
It's
what is
the
the sales
same
pitch? Like, tell them what you told them. I can't remember what it is. Sorry. Say what you're gonna say. Tell them what you told them. Then tell them again, or something like that.
And
No,
just
tell them. So it's tell them what you're gonna tell them. Tell them. Tell them what you told them.
That's it. Sorry.
Yeah.
That's
so
straight out of the manual.
It takes it away from here's ABC 1, 2, 3 street.
Yeah.
Here's the price per foot. Here's the cap rate, and start off with the neighborhood is the South Bronx. What an incredible story. The price per foot. Talk about it in context of growth and how much has changed and how much will continue to change. And the value on the price per foot is better in the Bronx than anywhere else in New York City. I don't know if that's actually true.
But just say it was, right? First, you have to grab their attention.
Yeah.
Then you can go down through the nitty gritty numbers. But to your point, I really feel like you have to be out there.
And then just talk about the Bronx all day long.
Yeah.
And say, Joe DiMaggio, Don Mattingly, and the Yankees number 23.
He knows absolutely nothing about baseball. So first you'd have to learn about baseball, then he can start his Bronx storytelling. He knows bricks though.
I know the bricks, yeah.
So I think anyway, I think that there's a story to be told about the growth and about the history of your neighborhood. And I do that over and over and over and over again, and no one does that. Yeah. When you're dealing with people that are out of touch with the creation of a building and a creation of a neighborhood. I grew up with the Garment Center in the West Side before in the early 2000s, right after 9/11, there was no Nomad. Flatiron was just Flatiron. There wasn't a Silicon Alley. There was no, the meatpacking district wasn't the meatpacking district it was today, or it is today. Soho was Soho, but it was way less than 4,000 a square foot for a Cartier property that just sold. So, you know, I grew up on the West Side. I grew up with the West Side. You're growing up with the Bronx. And you don't think about the neighborhood growing up the way you think about maybe your children, but we're all growing up in the neighborhoods we're paying attention to. So essentially, how long have you been in your territory now?
6 years.
6 years? So you're growing. I mean, 6 years ago, it was very different, wasn't it?
Yeah, well, Brookfield bought their site in 2018. When they planted their flag there, it's like bees around honey. Everyone kept following. You know, a lot of new developers entering that market.
So you're growing up with the area. That's your story. You got to tell it. And it's not your story. It's about the story about the Bronx, but you're growing up with the Bronx. And depending on, you know, gentrification, you bastard, like, you know, you got to be careful. Like, we built all these things. This is great. There's these towers. We kicked out everyone.
I like maturing and evolving rather than gentrification. Maybe that's a better word.
Yeah. So you've evolved with the neighborhood. And how cool is that? So that's your story. And you tell it in different ways. And then, you know, so that's essentially what we do. We bring lots and lots of visibility to properties. We bring lots of creativity and thought and love and care for actual physical bricks. We are landlords ourselves. We've done 7 projects. We understand how challenging it could be to create a tenant improvement package to build a space for the tenant within a tenant improvement allowance. And it's hard. It's really hard to property manage. It's hard to do it well. It's hard to do construction well. So we understand that, and we bring that sort of those black eyes and those knowledges to be like, wow, this place looks great. A lot of work. A lot of.
We often hear how much of a thankless job the management side is.
Oh,
margins are tight. You're just constantly getting hammered from both sides, tenants and landlords.
The tenant relations you need to be a special kind of person.
Yeah.
You really do, because they will call you about a leak and a problem in a bathroom and I don't like that. And it's, you know, even in office, it's very challenging. So to have that grace and to have that sort of understanding that it's hard. So good for you, landlord, you
can see it from many different perspectives because you've done it from many different perspectives.
Yeah. And so we bring that to the table. But ultimately, in this world today that we look at, it's the value you bring. We give your building flavor. We give it a pulse. We give it visibility, and we give it a brand, you know?
Right.
Awesome.
And that's like the key to it. I feel like being able to come up with a creative way to like sell the story.
Yeah.
And make it happen.
Yeah.
So in terms of investing then on the buy side.
Yes.
Right. How do you find an office building in New York City? It must be super competitive.
Throw a dart, right, on the map. No, I can't. But
that could be a strategy. You never know.
Yeah, I think that it's you know, to acquire an office building isn't the issue. I think it's acquiring the office building at the right basis and having a plan that you feel that you can execute on.
Right. And as we say, carrying the building.
Carrying the building. Who's the debt? Who's your equity? If you can buy all cash, this is the best opportunity for you. If you can't, then you have to figure out how expensive your debt is, and that has to be priced in. And then you have to do sensitivity as far as how long will your business plan take if it's just to rent it up? What if it takes twice as long? You know?
Yeah.
And just kind of
time sensitive, price sensitive.
Oh yeah, time sensitive, price sensitive, trade sensitive, management sensitive. But I do think, again, in general, in a sweeping statement, this is the best time of my career of purchasing, and it's been 22 years. This is way better than 08, 09. I have a lot of owners that bought in 08, 09 that did extremely well, but they levered at 65% post in the 2010s, and they're struggling right now. I have landlords that have owned for 30 years, and they're letting those properties go. And right here in a half a mile radius, there's on every single block, there's something. So it's not only about finding a good deal, it's what are you going to do with it? What's the strategy? Who's the correct partners to help you execute it? Who's the correct design team or the asset class? Is it a conversion? And then ultimately, is it worth the investment? You know, I invested in Amazon in the same time in 2020 of the summer 2020, and I'm at 2x. It was 25% a year,
And it was passive.
and completely passive. My money market's at, I think it's at 5.1. I do nothing. It just sits there. 5.1.
It's a beautiful thing, compounding.
It's a 5 cap with 0 risk, all cash. Right?
Makes the Bronx a tougher sell.
It makes
6.5
everything a tougher
cap.
sell.
Yeah.
If you, same thing, Amazon, Microsoft, all my healthcare stuff in the stock market. And really I came with this philosophy because I met an extremely wealthy gentleman. And I'm like, I think you could get to an 8% capitalization rate in this time. And, I think the exit could be blah, blah, blah. And he goes, that's interesting, but we really, really are looking, in the spectrum of business, private equity deals at a 20% return, private equity deals with a 33% return, stock market, just 8.33%. And the S&P 500 was over 20% this year. So you're competing with the entire spectrum of wealth management. And that's why alternative assets are only like 5-6%.
Particularly nowadays where the capital has the ability to flow all over the world. So you're competing on a worldwide scale with different investments.
Yeah. At the same time, that's why the story is so important.
Yeah.
We sell New York City. We sell a $2.1 trillion GDP city that does not have, the land, especially here in Midtown, the land, they're not manufacturing more of it. Where there's growth, where there's data, where there's statistics. At this point in time for commercial real estate, I think we're past the bottom. I think that everyone says, look at what the smart people are doing. KKR came out with a huge statement today. They're like, now's the time. I think the worst is behind us. Everyone, please invest in us.
I love it.
Invest in our funds.
Yeah, and people will.
And I think they absolutely will. Savannah Fund was first in the recovery, is always high net worth and private individuals. Then come the funds because of demand or requests, or they put out their fires if they had any previous. Savannah is a really interesting story because they had multiple assets that were underwater. And I met with Chris Schlenk in December of 22. And he's very, very matter of fact about it. He's very, very corporate about it, which he has to be. He can't be emotional about it, And then so he teamed up with this Greek billionaire and they bought 799 Broadway, which is, I keep mentioning that because it just sold yesterday.
It's fresh.
Yeah. They paid $1,400 a foot for in a Greenwich Village corner glass office building. I believe what it is at stabilization, a 5% capitalization rate.
Wow.
So that's interesting. So thank God for the funds, because for us talking 7, 8, 9,
they're
10,
kind of propping it up at that end.
Oh yeah. And so they have to deploy capital on an annual basis with the returns, risk adjusted returns. But when the funds come in, you are at the beginning of the recovery or the increase of valuation, in my opinion, than more institutional people. Because then once these people start competing with, ABC pension fund, they really only need a 4.5 to 5% fixed income. They're all about fixed income. the teachers' pension funds or the police pension funds. And so the funds come in first, then the institutions and the pension funds come in after that. And then the institutional capital take it, just add the flavor on top. And that's what we've been seeing in multiple cycles in recent history. So we're starting to see the funds come in, and that's where we are in the cycle. I think the worst is behind us.
So in closing, so we're at the end of 2024. We survived another year.
Yeah.
What's your big prediction for 2025?
I think it's going to be absolutely incredible. I think there's so much liquidity. The stock market's at an all-time high. Bitcoin's at an all-time high. Most other sectors are doing extremely, extremely well. And capital and money moves in herds or has a herd mentality. The last thing we really need to start seeing is a little bit of alleviation on interest rates. And I think that we have an administration that is aware of that. And although there is a separation of church and state with the Fed and the White House, I'm hopeful that there will be policies and there will be, ultimately, I hope that interest rates will come down. Now, I don't think it'll come down to 3% or 4% the way we've seen before on a 30-year fixed, but at the very least, mid fives. Right now, it spiked to 7, like a 30-year fixed for your first time for your house is at 7%. It spiked, the president was a president-elect. The rates went up, and we're like, we don't understand what's happening. But once interest rates come in sub 6, mid 5s, we're not even hoping for 4s, but mid 5s. I think that will be a compelling story because that means the money markets, there's $6 trillion sitting in money markets today. When the 5% becomes a 3.5, that's no longer interesting for a safe play. And that's when I think the 4.5 or the 5 for core real estate investments with credit and term become a lot more common and prevalent. And that's what I'm hoping for.
That will be huge.
That would be sick for 2025.
I love it.
All right.
That's a great
We need
prediction.
150 bips or 100 bips.
That's what we need. That's what we need to accelerate everything. But thank you for everything you do for our industry.
Thank you for having.
Thank you for being out there promoting real estate.
Absolutely.
And
thank you.
Here's to it.
I didn't even have my tea, so I'll take it with me on the road.
Have it to go. Cheers, Chris.
All right. Thank you. Thank you for having me.